Now,
All
let
right.
me just introduce both of you to the audience. So, unfortunately, Pavel Ezekiev couldn't make it, so he won't be able to join us today for this talk about the investor's view. But we can see that also my colleague Nikola is here to talk with us if he has any questions or something in mind. And welcome at the Reinventing Balkan Insurance event in the COVERYS room. Here we are speaking with Ivan Vachkov and Douglas Robert. Ivan is now live from Singapore. Doug is in UK, as far as I know. I'm here in Sofia in one co-working space. So I would like to invite you to share your views on the on investing, like in the little countries, what's happening there, and with the and let's start from here.
Certainly. Who should go first? Maybe Ivan. If I'll give you the privilege.
I'm very happy to. Just so that I'm clear, who is in the audience? Are we being streamed live to? Are there people who are not on the Zoom call who can hear and see us?
We are streaming directly to the Impact Hub from Belgrade. Our colleague Stefana Stosic is in the Zoom here to help us. Yeah, but we unfortunately we cannot see the audience right through the Zoom, so we won't be able.
No, that's fine. That's fine.
Yeah.
I just wanted to know sort of who we're speaking to. I mean, look, what I find really interesting about the smaller countries is that very often you can have adoption of technology that is actually quite fast. In countries that are sort of sub 7-8 million population, the regulatory bodies are small. Therefore, they cannot really exert the kind of pressure and oversight. They don't have the knowledge. They don't have the resources. So we have seen a lot of smaller countries completely skip entire cycles in insurance technology adoption. I wouldn't say as far as advanced things like blockchain or automatic claim settlement, but certainly I've seen creative work done on the capital side. I have seen digital distribution be adopted a lot quicker than in places like Germany and Japan that are considered advanced countries. And especially out here in Asia, where we have, you know, a small country in Asia is still quite a big country. We tend to find that the young population means that most consumers are digitally native. So to them, it's completely absurd and foreign to do anything in insurance and increasingly in banking in person and in paper. So we just had the launch of the first digital native bank in the Philippines, and it attracted over 1 billion pesos of deposits in less than a month. It would be very hard to see something like this happen in a lot of the bigger countries where we operate. So to me, I think the key message is very fast technology adoption, skipping certain cycles of adoption on the regulatory side, and most importantly, a customer and a consumer that's digitally native and loves fast service delivered over the internet. So that's sort of been my impression. I don't really, being in Asia, I don't really have a detailed view of Macedonia, Albania, Montenegro, some of the smaller countries in Southeastern Europe. Maybe Doug has a view there, but that's at least what I'm seeing.
Yeah, I think I couldn't say it better in relation to the adoption of technology. Certainly in smaller countries, you get a lot more the ability to jump maybe 2 or 3 steps on the back of not having as much sort of bureaucratic infrastructure that exists with larger countries. I mean, the challenges in Europe are that we have a very mature insurance market. Eastern Europe less so. I mean, the growth rate, as I mentioned this morning, for global insurance is roughly 4.7%. In Europe, it's about 4%. In Eastern Europe, it's approximately 1%. But that doesn't mean that innovation isn't happening. I think the problem that a lot of the insure techs have, certainly coming from the Balkans, is how do you differentiate yourself and get out in front of the pack of a marketplace that's very saturated with solution providers right now. But there is call for lots of change in customer experience, lots of change in relation to claims management, and global insurers are putting a lot of money in to try to find the optimal partners to be able to invest in to deliver those services for them, because they've proven to be unreliable when left to their own device.
Thank you. And then I wanted to ask, like, the opposite part, the overview of each portal of the globe. Yeah, in the UK, what's the difference? What's happening there, and then in Singapore?
Yeah, okay. So from a UK's perspective, there was tremendous investment. I think John Byrne in the last talk from InsurTech Ireland talked about the investment position for InsurTechs. I think globally there was around 5.2 billion pounds invested, despite some significant challenges. I think in the UK, the strange thing, and I don't mean this to be a criticism of all InsurTech entities, but the strange thing is we tend to run into a lot of companies that almost have a semi-schizophrenia that actually was also addressed in John's last presentation, and that is determining exactly what they are. There are many investment pitches that you go into where the people start off talking about being service providers to the insurer, then pivot to say that they're a SaaS provider to everyone, then pivoting to say that they're an insurance agency. So you really kind of, I guess it depends on when and who they're talking to about valuation of their businesses that they determine who they are. But here it's a pretty vibrant environment where there's a lot of money being put into investments, specifically in the InsurTech space, due to the fact that there's huge inefficiencies that exist in insurance. Even if you look at the supply chain, which is where I'm predominantly involved, there is increasing legislation and challenges of how do you deal with the supply chain where investment returns are low, expenses are increasing ever so, and insurers are trying to grasp with relevance for the future. So it's a very vibrant market, but it's kind of chaotic in a way.
It's an interesting juxtaposition. What we have in Asia is almost two markets. If you take North Asia, the more mature, older part of Asia, it's basically a market that's barely growing, aging population, all the challenges that brings. And you have a fairly archaic model of distribution. And as a result, basically most of the innovation that we see, and I'm leaving China out of this because China is a completely separate story in almost every way, is that most of the innovation happens around distribution and product, but there is very little happening elsewhere. And that's sort of market one, and that's the big rich countries, Korea, Japan, to a small extent China, Taiwan. So there it's literally a distribution game. You've locked up the distribution, you've got the agent sales force, you're kind of dabbling in digital, but it really doesn't move the dial for you very much. And your entire business model is built on a strong reputation, strong distribution, strong capital ratio, and a tradition and history. And you move further south in Southeast Asia, and things are completely different. Singapore is kind of a good example of both of these things. We had an insurer called Singapore Life, which is digitally native. It started only a few years ago, and it recently bought out Aviva, which is one of the big traditional players here in Singapore. So you've had actually the fintech swallow the traditional company. And if you move further sort of south into places like Indonesia, there people are experimenting with microinsurance. So now when you order a taxi in Singapore and in Indonesia, you get insurance per trip. You have specific driver insurance, you have all sorts of mini little hacks, which actually, because they're digitally native and the distribution cost is very small, they actually make sense at small scale. So we're seeing very, very rampant innovation in the non-life market slash sort of transport and P&C. And we're seeing very little movement in where the big bucks is, which is life and sort of critical illness and that stuff. So it's almost schizophrenic in the way that Doug put it, that you've got these two markets listing with more or less the same consumers, but behaving completely differently. So I'm really interested to see where that goes.
So there are many similarities, but and what's going on in terms of investment in the in insurtech, especially like yeah.
Yeah, no, investment wise, I mean, you know, the amount of money that's being thrown around is considerable. And just to give a brief story, I'm quite involved in this space in Europe. I mean, we have a distribution business that is looking at growing around a 400 to 500 million euro gross premium distribution business across all of Europe. And each one of those countries, I look at different type of insurtech businesses, broker businesses, insurance agency businesses, as well as actually risk-bearing entities, which is for very specific parts of our business strategy. And in the insurtech space, I came across, and this will probably be a combination of three companies that I'm thinking of, but they all had similar characteristics. They started off by saying that they were well, they weren't even pre-revenue. They were making money. They were generating money. I don't know if they were making money or if they will for a while. They all described the world of inefficiency in a way in which they'll be able to completely upturn the standard practices within insurance, if only they could also have access to insurance paper. And their models, they started off by in at least, well, again, this is an amalgamation of three different stories. They started off with one valuation, and by the time they finished the discussions, they tend to actually have a higher belief in themselves and have increased in the same meeting their own value, to the point where they're just going for high valuations. And that's because there's money out there that's willing to throw at it. I mean, unfortunately, that's not the business that I have, that we invest in, because we're more bricks and mortar. But there are people out there, lots of funds, that are willing to punt the ball because cash is available, returns are low, and they're trying to find places to put money. Sorry, that might sound a little bit derogatory in my comments, but it's just sort of the experience that I've had.
No, I would actually echo that. I mean, I come across, at least in Asia, very often businesses that are, you know, solutions in search of a problem. And we sort of went through that with blockchain in 2017, and now we're seeing some progress on distribution. But the truth of the matter is, especially in life and some of the big PNC, you've got enormous capital pools which are still intermediated by the big insurers, and you don't have a scenario in which a fintech that just takes one small part of the value chain can ever be shown anything meaningful to grow. So what happens is, again, I can only speak for Southeast Asia. I've lived here sort of for the past 10 years, so I'll defer to Doug on Europe and the US. But what we're seeing is a lot of innovation in health tech, which I'm a sort of, I guess, part of. And that innovation, you get a lot of proof of concept experimentation from the insurance, and you get a lot of sort of early engagement. But when it comes to really disrupting their own models and taking on some of the solutions, be it preventive care or paying people to stay healthy or all the things that we talk about as the future, you get a violent reaction of sort of retrenchment. So they're very happy to experiment and play with small money, but the insurers themselves, I don't think, are genuinely investing enough in disruptive technologies. They tend to be a little bit more defensive in their thinking, and you can see why. That aside, though, you have completely new entrants like Singapore Life and some others that basically come and take an entire bite out of the value chain. But in places like Singapore, you still need to be incredibly well capitalized to do that, both in banks and insurance. So those situations are quite rare. So you have a very vibrant ecosystem of small players trying to sort of graduate beyond just proof of concept. But above that, I would have liked to see a lot more movement. In that sense, I think banking is actually making more progress because you now have end-to-end challenger banks, payment companies, crypto payment companies, and all sorts of conglomerates that are really taking the end-to-end value chain. I see less of that in insurance. The even claims processing these days, which is a process that should be more or less digital, is still very much handled the way it was handled 10, 20 years ago, which is completely astonishing to me, at least in a country like Singapore. And I'm sure there's regulatory reasons for that as well, but nevertheless, I think I would give sort of the innovation cycle in insurance probably a C- at this stage.
Well, I'm for my sins, having worked in insurance for 24 years now, I couldn't agree more. I mean, I still witness people walking through London Market when I have the occasion to go into London, carrying what's known as slip cases to have people physically sign and stamp pieces of paper to affirm coverage for particular risks. I think some things that stand out, insurers are absolutely very slow to respond to the change in need. I think some of that comes from, I mean, if you look at statistically, like 80% of IT spend in most insurance companies is spent dealing with legacy systems. So disruptors, new entrants, they have the ability to not have to deal with that, which is a challenge. And I don't, I worked for, I think I shouldn't, you can look up who I worked for, but I've worked for companies that have gone through lots of M&A. A decade after they purchased the companies, they were still dealing with integration issues of old IT platforms, as opposed to just like really scrapping everything and evolving. One other point that I would point out is insurance distribution as well hasn't really grown up. They're moving faster. They're responding better, much in some ways like bank and bank assurance, to providing insurance solutions to the marketplace. Insurance intermediation in the United States, roughly 33 to 40% of insurance intermediation is done by way of wholesale broker or agent. In the UK, it's around 15 to 20%. This is according to Boston Consultancy Group. And in Europe, continental Europe, it's around 10%. Now, what that means is that it's a very fragmented distribution model throughout most of Europe, even more so possibly in Eastern Europe. And there is no consistency or conformity to a standard. So everybody's left out there trying to maneuver the waters and come up with their own independent solutions, being highly defensive about sharing back and forth. And all that does is it just causes a lot of inefficiency, stalemates, nobody moves forward. And really, there are some people that are trying to break this cycle, and they're doing some interesting stuff. But unfortunately for me, it appears to be very far away.
Thank you for your thorough answer. And well, in this matter, I think about the less developed markets and countries. How can money be like brought to them, and just maybe like there won't be this much graduation between this? Is it because not only because of the COVID situation, how it's maybe, I don't know, affecting the market, but maybe some kind of a national psychology, or I don't know. What do you think about this?
If I understand the question correctly, I mean, what insurers can do to actually improve or better their promotion of sort of changes in the way in which they receive these types of technology. I mean, a lot of it has to do with shocks. We've just gone through a massive shock. And unfortunately, dependent upon the country, insurers haven't necessarily painted themselves with the best brush, because the lawsuits that occurred for business interruption claims brought on by COVID in the UK is an example where distrust is kind of sunk even further into the public dialogue. In other areas, what we can do is we could just be actually smarter with our assets and realize strategically what insurers are there to do. And it's there to provide a promise to pay. And as a result of that, partnering and really trusting technologists, trusting distribution, and being smarter with the way in which they deploy their capital, I feel like will serve them in the future. Most insurers that I know, for legal regulatory reasons, decide to set up fiefdoms all around the world. And then you get into a challenge with, I'm allowed to trade this product in this country, but I'm not allowed to do it in another country. Under the European Union, it should be quite plain and simple. And the only way to reach the lower, shall we say, the lower ends of the economy in relation to small to medium enterprise and real retail personal lines business is to not do it yourself through traditional bricks and mortars way. It's to find good and stable technology that really has the opportunity to capture distribution and then partner with them and go into the market. Because if the insurers can bring the capital and the insurtech can bring the technology and the distribution, and you have freedom of services that governs all of that in Europe, allowing you to export or passport your own capital into countries, it should be an easy enough solution in many, many product areas. I hope that was the question. If it wasn't, apologies for my lengthy response.
Well, the question I'm choosing to answer as well is how do we bring innovation and capital to these smaller markets? And I honestly don't think this can happen top down. You can't just create an environment where the big insurers come in and invest, purely because the costs of setting up the distribution channels of technology are more or less the same whether you do it in a market of 2 million people or 80 million people. So to me, the way that innovation reaches these markets is in one of two ways. Either there's a strong bottom-up process, a particular country where, let's say, the top 3 insurers have lower market share, or a big local player decides to go and really disrupt a part of the value chain. I'm thinking maybe a state insurer that's been sold to a financial conglomerate rather than necessarily one of the big insurers, and they just say, you know what, we're just going to do things very differently, and what works specifically in this country is XYZ because there's a certain lack of trust here, or a lot of trust there, or a certain setup where they have extraordinarily high profitability because of legacy things and they can afford to invest. So bottom up local player in one country, I can see it. I don't believe it, but I think that's probably the only scenario. I think otherwise what will happen is the exact same thing that's happening in banking, which is the big conglomerates like Allianz and Zurich and all the other big primary insurers will come up with innovations, experiment in certain markets, normally the bigger ones in a few cities, then that innovation will eventually be adopted by the whole country. And, no less than 5 years later, it will eventually reach my home country of Bulgaria or some of the others as, a technology refresh. But for small markets, financial services innovation is not really incentivized purely because the investment spend is the same. So to me, that would be the only way. Is if Allianz says, you know what we have in Stuttgart is going to work in Sofia, so let's just implement that. But again, to clear the local regulator, to rewire the local processes, especially when you've bought a legacy insurer, I am not that hopeful. The only exception that I would make is that what we're seeing now in banking is that JP Morgan spent all this time laughing at Square and Stripe, and now they treat them as formidable competitors because they're multi-billion, $100 billion companies. But these companies themselves are being disrupted by decentralized finance companies, right? So if decentralized finance, for whatever reason, manages to get some scale and pass regulatory clearance, then you can have innovation that is really uniformly distributed, because the wealthy and mobile young people of Bulgaria and Russia and Serbia and Macedonia have a lot more in common than the wealthy mobile young generation in London than they do with the rest of the country. So they will adopt Revolut just like they did in London. And I think that would be the way to do it. But I am not that hopeful because the insurance cycle is a long lead liability capital intensive business. And I think the incentives to allow disruption is even smaller than there is with banking, which is a shorter duration industry. So a long answer, but I don't want to come across as story, but yeah, don't hold your breath just yet.
Well,
I think it has to trickle down. Yeah.
You've just given me a PTSD moment, flashbacks with actuaries where in insurance, in particular in liability insurance, we used to get into debates about being told, if you're right, if you're wrong, we'll know today. If you're right, we won't know for 7 years. So to Ivan's point, these are capital intense businesses, and they're making bets on what the future will look like 7 to 10 years down the road, but also adopting, in some respects, when it comes to technology, sort of a strategy du jour mindset that usually accompanies every new executive that walks in. That's why I actually, taking on board everything that Ivan's just said, I think about it being, if a carrier really wants to enter into a smaller market in the Balkans, like an Allianz, Zurich, et cetera, the best way to do it is through partnership and actual trust, and figure out the local dynamics of the country from a reg perspective, a legislation perspective, and then offer the products and capital, but don't get involved in the distribution of the product. Just let it happen normally. And I say this humbly as an American who's been selling liability products in Europe for the last 18 years. What we tend to do is take these products, translate them into languages because they happen to work in one particular country where we incubated the idea, say like cyber liability insurance, and then translate it into Bulgarian, throw it into the market, have the same pricing tools and all the same scare tactics to sell the product, which isn't necessarily locally relevant, and then expect people to just sell it. That doesn't really work, because it was almost, it is a push strategy versus a pull strategy, which should be where they engage in partnership, come to the market with capital and product ideas, and then work with local distribution or insurtech companies to develop those ideas, and then just let it happen. It's probably how, well, you would get more organic activity, I think, in a market, and more homegrown solutions that you might be able to then extract and export, than by just coming in with a bulldozer and saying, here's everything I sell, please pay me the money. And you notice that a lot with cyber. Apologies if I get product specific, because we harp on in relation to GDPR and the fines and penalties payable. I've been involved in that project in relation to push strategies. And what you find is certain countries looking at it and realizing that it's an issue, and certainly they expect that they will be attacked, but then running their business is an issue. And when they pay 50 to 100 euros for a commercial combined contract in their respective country, just to be able to run their business, for them to be expected to pay, shall we say, UK prices for something that they don't quite understand the quantum or the value of having, it's not clearly articulated to them the benefits. And again, so I'll close by what I started with. Partnership for me is the best way to do that. You bring the capital, the ideas, let it grow organically, and partner with good data analytic and technology companies for the distribution of product.
Thank you. And as for the example for Revolut, many people in Bulgaria are using it, or maybe, I don't know, like most of my my friends. And now I would like to bring to your attention Nicola, my colleague. He's here with some questions from the audience, maybe for you, Nicola.
Yes, of course. I'll not disclose the sources of the questions, but I do have one. I'll start with one which is a little bit more provocative. It's for those that are less experienced in the field. And I think it can bring a good discussion. It's about what is the real difference or the limiter between the fintech and the insurtech, because for many, they sound quite similar. Now, in a closed audience, we know that this is not the case, but for many people that kind of use like synonyms, which they are not. And just to expand a little bit to that, do you believe that the rapid development in fintech will fuel or accelerate the insurtech area, or it's just going to cannibalize it at some point?
Doug, why don't I start on fintech versus insurtech, and I'll let you lead on sort of the second part of the question. Look, at its very core, there is no definition that I think is commonly accepted, but fintech tends to mean more banking and transaction-like product. You know, most of fintech until sort of a few years ago was basically payments, some elements of distribution, you know, some savings products. And if you think sort of as far back as the early 2000s, when ING started ING Direct, which was an online bank, I think fintech sort of took that aspect, which is savings, payment, transaction-oriented, a little bit of securities brokerage, but normally banking and capital markets related activities. That tends to be a shorter life cycle product. So I would say, in my mind at least, it's a little bit faster moving. And also regulators have been far more willing to set up what they call regulatory sandboxes for fintech. And when blockchain arrived on the scene sort of a decade or so ago, that really accelerated. And most of the blockchain tokenization of protocol has happened in that segment. So banking, transaction services, far less so in insurance and far less so in securities trading. So to me, fintech would be more banking, and insurtech would be more sort of process optimization, distribution oriented, you know, process recalibration, if I had to say it. So it moves a little bit slower. And there, my experience at least is, and I'll defer to Doug on this, is that regulators are far less adventurous. I've seen very few insurance sandboxes because you're dealing with people's life savings, their well-being, et cetera, rather than them losing some deposits. So I have found there to be that distinction. But I don't know, Doug, would you agree?
Yeah, I mean, I think, you know, insurtech is a subset of fintech, and it addresses the administrative, the administration, the distribution, and the processing of claims. Most of what I see focuses on distribution, capturing the customer, and creating a customer experience. But I know it's probably an overused joke that, you know, insurtech, it wasn't called mail tech when email came out. So insurtech is just an evolution of insurance to be more open and receptive to technology to improve process. So I don't think, I don't necessarily think that the regulators take a position one way or the other, because most insurtech companies that I've seen that get involved in the distribution tend to get regulated as if they were an insurance intermediator, because that's what they're doing. And, you know, when I was at one of my previous employers, we talked a lot about like connectivity and being involved in more of the customer's life. And insurance, unlike the developments in fintech, with insurtech, you know, nobody really wants to be involved with their insurance because, frankly speaking, you're either forced to buy it, and I'm just, you know, speaking things we all know. You're either forced to buy it because there's some sort of legislative or regulation that requires you to purchase insurance, and then you don't think about it until the point in time in which you need to claim. Therefore, you do not want your insurer engaging with you on a regular basis because there's no real relationship happening. So, you know, the insurtech is a subset. It really focuses on distribution, creation, administration, claims handling, but it doesn't really do that much more until I probably get assaulted by possible participants in this call.
Thank you. As you may have saw, the Desisław was here waving to us. He wanted to join you and talk with you a little bit, but he's having a conversation in another room. Unfortunately, he can split into for now. We don't know where technologies will go. Thank you very much. I can see that our time is coming to an end. So I would like to thank you and to ask you, do you think if something comes in mind to you that you would like to share with us and we haven't talked about it, maybe, I don't know if you have thought something.
Well, from my perspective, having looked at, I set up this business around 2 years ago, and we've talked to over 50 insurtech companies across Europe, and I'm always absolutely excited about the fact that people are excited about insurance. So I don't want to ever tamper the enthusiasm that exists out there. I think one thing that you need to understand is for the insurtech companies themselves, that there is a lot of investment because people available because people are looking for solutions, but you really need to focus your documents or your pitch to have a focused strategy and not pivot as much as I mentioned before. And this is a very common phenomenon that occurs with insurtech companies that I talk to. They start with one thing and they end up being a different company or whatever the investor wants in the course of the same discussion. So I really think, focus on what you're good at, focus on what the market is missing and where there is value, and then try to find a partner that sees that vision in you and is willing to support it all the way through. There's a lot of competition, but then again, be that person that shines above the rest when looking for investment, by the way. So that's the only thing I would offer.
Doug is a tough act to follow on the topics of insurance, and certainly his passion is notable. What I would say is that if I was starting a technology business today in the space, which in a way I am with a sort of a health-related initiative, is I would look for personalization. I think what the digital services are unique in is they can really, really personalize at a very, very granular level. And right now, the whole of insurance is based around risk pools that are homogeneous. And to me, a lot is lost on not understanding the individual properties of most clients. And digital allows that. So the companies that are going to win are going to be the companies that design more sophisticated risk surfaces by taking more and more data and being able to refine their data sets. And everybody's known this for a really long time, but it seems like now it's possible. 5-10 years ago, you wouldn't necessarily trust internet information about your health and well-being in a way that you maybe perhaps will today. And I see a lot of opportunity in the space, but not a lot of movement. Everybody's still focused on rewiring existing processes rather than reimagining sort of new ones. So that'll be sort of my thing, is personalization of risk, personalization of distribution, and personalization of incentives would be the three things that I think are missing in insurance and are getting better at banking faster than they are in insurance.
Thank you, Doug. Thank you, Ivan. Thank you for all those advices, insights, and knowledge. It was great pleasure talking to both of you. And Nicola, thank you too for your support. Thank you to the audience who was watching us. Please be welcome to our movie screening, which will be held like 1 hour later. As you see in our program, the movie is called The World in 2042, an inspirational tale from the future. Thank you,
Thank you, everyone.
Thank you very much.
All right.
Thank you, everyone.
Bye.